The RBI traditionally followed the so-called balance sheet approach, and it is only the Chakravarti Committee which decided on the monetary targeting framework, and it transformed the monetary analysis at the RBI by embracing the money multiplier approach, given the association between reserve money and money supply. A central bank balance sheet is usually analyzed from the twin angles of the ability to issue currency and the ability to achieve the monetary policy objectives of price stability and growth. In order to track the channel of transmission of monetary policy, most monetary authorities redraw the assets and liabilities from their balance sheets to compile the following two macroeconomic liquidity aggregates by classifying liabilities according to their moneyness and by classifying assets and liabilities by sector of origin rather than the type of the financial instrument. 1. Reserve money, comprising currency and bank balances, which generates money supply through the process of credit creation, and excess bank reserves, that is, the balances banks maintain with the central bank over and above their reserve requirements, and settlement balances, which is now called voluntary reserves, which in turn serve as a measure of bank liquidity. Central bank accounting practices assume importance not only because of the usual concerns about balance sheet health per se, but also because of their monetary and fiscal implications. Most central banks usually follow conservative accounting norms. For analytical purposes, excess reserves can be decomposed into one, borrowed and non-borrowed reserves, ending on commercial banks' automatic access to primary liquidity, as conceptualized by the federal, and 2. Autonomous factors and discretionary factors depending on the central bank control over its balance sheet, following the European Central Bank called ECB in terms of sources of funds. Most central banks conduct monetary operations through a mix of instruments such as open market operations and occasionally changes in reserve requirements and standing facilities, which adjust the quantum of primary liquidity and changes in policy rates, which impact the price of base money. The ripple effects of each monetary instrument throughout the central bank balance sheet are very situation specific.
After studying this module, we shall be able to learn how to analyze the RBI balance sheet and its importance, understand different instruments of monetary control. The RBI traditionally followed the so-called balance sheet approach, and it is only the Chakravarti Committee which decided on the monetary targeting framework, and it transformed the monetary analysis at the RBI by embracing the money multiply approach, given the association between reserve money and money supply.
The structure of assets and liabilities of the Reserve Bank are more or less in line with the stylized balance sheet followed by most central banks. The accounts of Reserve Bank are, however, bifurcated into the issue department, reflecting the currency issue function, and the banking department, accounting for all other central banking functions such as banker to the government and banks. In terms of Section 23(1) of the Reserve Bank of India Act 1934, following the recommendations of Hilton Young Commission 1926, given in RBI 1970 and RBI 1983. This was primarily to ensure the sanctity of the currency issue function of the Reserve Bank, in line with the then existing practice of the Bank of England. We take a quick rundown through the items of the balance sheets of the issue and banking departments as a prelude to the discussion on balance sheet dynamics.
A stylized account of asset and liabilities of the issue department is presented in the table. The liabilities of the issue department comprise the vault cash in the banking department and the notes issued to the public, banks and treasuries under Section 22 of the Reserve Bank of India Act 1934, which accords the Reserve Bank the sole right to issue bank notes. The assets eligible to bank the issuance of notes under Section 33 include gold coin and bullion, eligible foreign securities, Government of India rupee securities, rupee coins, and eligible internal bills of exchange and other commercial paper. The structure of assets and liabilities of the Reserve Bank are, more or less, in line with the stylized balance sheet followed by most central banks. The balance sheet of the banking department reflects the Reserve Bank's function as banker to the government and banks. The balance sheet effects of monetary policy actions in terms of changes in investments in government paper and foreign assets span both the issue and banking departments. The liabilities of the banking department, comprising the capital account, national funds, deposit liabilities, and other liabilities, can be analytically partitioned on the basis of their moneyness. Non-monetary liabilities essentially comprise the Reserve Bank's dues to its owner, paid-up capital, and on itself, reserves. Balances parked abroad, such as IMF account number 1, and illiquid provisions, such as employees' provident funds. The bulk of the deposit liabilities, along with currency issued outside the Reserve Bank, are monetary in that they provide the base for deposit creation as components of reserve money.
Assets and liabilities of the banking department of the Reserve Bank of India. The liabilities include capital paid up, reserve fund, national industrial fund, which includes long-term operations, national housing credit funds, that is a long-term operations, both government, central government, state government, banks, which include scheduled commercial banks, scheduled state cooperative banks, other scheduled cooperative banks, and non-scheduled state cooperative banks and other banks. Other bills payable, other liabilities. The assets include notes, rupee coin, small coin, bills purchased and discounted, both internal as well as external, and government treasury bills, balances held abroad, investments, loans and advances to central government and state government, loans and advances to scheduled commercial banks, scheduled state cooperative banks, other scheduled cooperative banks, non-scheduled state cooperative banks and others. Loans and advances and investments from National Industrial Credit Fund, that is the long-term operations, loans and advances to A. Industrial Development Bank of India, B. Export Import Bank of India, C. Industrial Investment Bank of India, D. Others. Investments in bonds or debentures issued by 1. Industrial Development Bank of India, 2. Export Import Bank of India, 3. Industrial Investment Bank of India, 4. Others. Loans, advances and investments from National Housing Credit Fund, that is the long-term operations, which includes A. Loans and advances to National Housing Bank, B. Investments in bonds or debentures issued by National Housing Bank and other assets.
The capital account, in the strict sense of the term, comprises the paid-up capital of Rs 5 crore fully owned by the Government of India since 1 January 1949 under Section 4 of the Reserve Bank of India Act 1934, and reserves comprising the initial contribution of Rs 5 crore by the central government in terms of government securities under Section 46 and transfers following gold revaluation up to October 1990. Other reserves, including the contingency reserve and asset development reserve under Section 47, and revaluation accounts, including the currency and gold revaluation account and the exchange equalization account, are parked in other liabilities. National mutual funds, the second set of liabilities, were constituted from time to time out of contributions from the Reserve Bank's disposable surplus under Section 46(1) to provide agricultural credit 1956 to 82 when money was transferred to the newly constituted National Bank for Agriculture and Rural Development, industrial credit 1964 to 2002, and the National Housing Bank. The third set of liabilities include deposit balances maintained by the government, banks, and other eligible parties. The central government deposits all its cash balances with the Reserve Bank free of interest, subject to a mutually agreed minimum under Section 20 and 21 of the Reserve Bank of India Act 1934. Minimum cash balances of the state government are linked to the volume of budgetary transactions in accordance with agreements under Section 21A. Scheduled bank deposits with the Reserve Bank include their required reserves as prescribed under the Section 42(1) settlement balances and excess reserves. Non-scheduled banks are required to maintain a minimum of 3% of their net demand and time liabilities in various eligible forms, including in current account with the Reserve Bank under Section 18 of the Banking Regulation Act 1949. Other deposits comprise, mainly, deposits of quasi-government and other financial institutions including primary dealers, accounts of foreign central banks and governments, accounts of international agencies such as the International Monetary Fund, IMF, etc., provident, gratuity, and guarantee funds of the RBI staff, and some temporary accounts. The final set of liabilities include a broad head of other liabilities, and bills payable include mainly outstanding drafts, telegraphic and mail transfers, and payment orders drawn up by the Reserve Bank's offices. Besides the reserves and revaluation accounts, other liabilities include a number of current income accounts, other sundry liabilities and special deposit accounts such as the Resurgent India Bond, India Millennium Deposit Maintenance of Value accounts. The assets of the banking department comprise financial assets such as claims on the government, banks, and other eligible financial institutions, and other assets in the form of loans and bonds and non-financial assets such as immovable property. The loan portfolio includes advances to the government, banks, and financial institutions under Section 17 of the Reserve Bank of India Act 1934. Ways and means advances WMA to the central government. The investment portfolio of the banking department comprises investments in the share capital of the State Bank of India and other financial institutions.
Ways and means advances to the central government under section 17(5) are payable within 3 months from the date of advance in accordance with agreement with the government in respect of the maximum amount and rate of interest. WMA to states encompass normal WMA linked to the 3-year average of revenue receipts plus capital expenditures, special WMA provided against holding of government securities and overdrafts up to 10 consecutive days within limits linked to normal WMA limits. Credit to banks and financial institutions, including primarily dealers, is typically in nature of refinance against government securities, besides National Bank of Agriculture and Rural Development. NABARD enjoys 2 lines of support: general line of credit called GLC1 against loans to commercial and state cooperative banks for agricultural loans, and GLC2 as a financial institution per se. The investment portfolio of the banking department comprises investments in the share capital of the State Bank of India and other financial institutions, government paper held in the form of treasury bills and dated securities, including reverse repos, special securities by the government in favor of the Reserve Bank for various purposes, including revaluation of the resurgent India bonds called RIBs and IMDs, gold bonds 1998, and foreign securities including swaps.
The other assets of the banking department include money in the banking department in form of rupee coins, which is a claim on the issue department, and small coins, which is a claim on the central government, and other assets including the value of gold held in banking department, premises, furniture and fittings, debit balances under various heads of expenditure pending transfer to profit and loss account, loans and advances granted to members of the staff towards housing, purchase of motor vehicles, etc. The Reserve Bank has now discontinued schemes of discounting various bills.
The methodology of analyzing the Reserve Bank balance sheet has evolved over time along with the particular monetary policy framework in vogue. The Reserve Bank traditionally followed the so-called balance sheet approach, also called the structural or credit counterparts approach, of examining the variations in money stock as given in RBI 1961-1997, Jadhav 1994, Jalan 2002. A focused analysis of the Reserve Bank balance sheet began with Reserve Bank's first working group on money supply in 1961, which introduced a parallel construct of the monetary base called government money deemed useful for forecasting money supply. Although the case for compiling reserve money was revived by Gupta in 1976, a number of Reserve Bank economists were critical of the underlying money multiplier theory, terming it as unduly mechanistic and unsuitable for operational significance, as it did not take the relationship between the monetary and real sectors into account. As written in Shetty et al. In 1976, Chona in 1976, Madhur in 1976, RBI in 1977 and Khadkhate in 1980. The monetary targeting framework recommended by Chakravarti Committee transformed monetary analysis at the Reserve Bank by embracing the money multiplier approach, given the reasonable degree of association between reserve money and money supply, as given in Rangarajan and Singh in 1984, RBI in 1985 and Rangarajan in 1987.
A focused analysis of the Reserve Bank balance sheet began with Reserve Bank's first working group on money supply, which introduced a parallel construct of the monetary base. The monetary targeting framework, recommended by the Chakravarti Committee, transformed monetary analysis at the Reserve Bank by embracing the money multiplier approach, given the reasonable degree of association between reserve money and money supply. While the two approaches are useful for tracking money supply, a third and more recent paradigm of monetary policy links the movements in the central bank balance sheet to the determination of interest rates through bank reserves. One methodology is to compute excess bank reserves as the sum of autonomous and discretionary liquidity by partitioning the Reserve Bank's balance sheet flows on the basis of policy interventions. A second related methodology is to decompose excess reserves into exogenous factors and forecast able factors on the degree of predictability and policy position.
To the extent that excess reserve is essentially an ex ante measure, the Reserve Bank has recently experimented with an ex post measure of the liquidity overhang crystallized as the sum of the balances under repos under the liquidity adjustment facility and the market stabilization scheme.
The Reserve Bank has traditionally followed the most conservative canons of central bank accounting in its accounting practices. The Reserve Bank satisfies, by and large, the Code on Transparency of Monetary and Financial Policies framed by the International Monetary Fund in terms of the following three criteria, viz. Releasing data in consonance with the IMF's SDDS standards, disclosing balance sheet on a pre-announced schedule, and, after a predetermined interval, disseminating selected information on its aggregate market transactions. The Reserve Bank Central Board submits the annual audited accounts together with a report on its working to the central government after due approval in its August meeting within 2 months of the end of the accounting year. The formats of the profit and loss and reserve fund accounts are prescribed in the Reserve Bank General Regulations. Besides the annual accounts, a weekly statement of affairs (WSA) of the issue and banking departments, as at close of business on Friday, is transmitted to the central government after due approval of the weekly meeting of the Committee of the Central Board, which usually meets on the Wednesdays.
A consolidated statement on the assets and the liabilities of the Reserve Bank is published in the weekly statistical supplements called WSS, which is released the following Saturday, while accounts of the issue and the banking departments are published in the Reserve Bank Bulletin by the beginning of the following month. In terms of monetary impact, there is very little difference between the audited balance sheet and the weekly accounts because the suspense accounts net the surplus from the day-to-day operations pending appropriations, which is in the nature of non-monetary liabilities.
In view of the growing importance of the strength of the central bank balance sheet, with financial liberalization, these practices have been further tightened in the 1990s. This has been accompanied by greater transparency in terms of balance sheet disclosures, including prior commitment to certain balance sheet allocations, such as the transfers to the central bank reserves. This is reinforced by data on forward asset liabilities, money market operations, and now daily bank reserves. The main instruments with which the RBI used to control the money supply in the economy are reserve requirement, rediscount windows, secondary market operation including repos, foreign exchange instrument including swaps. The relative efficiency and costs of various instruments of monetary policy poses a second set of challenges for the conduct of monetary policy. The central bank's power to conduct monetary policy stems from the fact that it is the sole source of primary money in the economy. Given this monopoly, the central bank is typically able to fix either the supply or the price of primary liquidity. Sometimes it can even control both in relatively imperfect financial markets. The dominant model of monetary design is usually to fix the supply of primary liquidity in consonance with the broader money or interest rate target. The issue, then, is to determine the form and pricing, administered or market determined, of primary liquidity.
Instruments of monetary control. Reserve requirements. The main advantage is that it improves predictability of reserves and useful in economies without functioning markets. Its disadvantage is that it imposes tax on financial intermediation. The major issue in its design is definition and monitoring of requirement base. Averaging provides flexibility in banks' portfolio management. Rediscount window. The main advantage is that it has important announcement effects. Its disadvantage is that it is not very convenient for liquidity targeting. The major issue in its design is that the determination of eligibility and access criteria. Secondary market operations including repos. The main advantage is its immediacy of response in money market and also facilitates market development. Its disadvantage is that it requires deep and liquidity secondary market and the central bank must have sufficient stocks. The major issue in its design is the pricing policies. Foreign exchange operations including swaps. The main advantage is that it is effective if foreign exchange market is more developed than government securities market. Its disadvantage is that central bank can suffer losses if exchange rate is unsustainable. The major issue is that it needs to design appropriate risk management procedures. A unique feature in emerging market economies during the 1990s has been the sudden gusts of capital flows. Most central banks have attempted to balance the domestic and foreign sources of liquidity through sterilization operations in order to diffuse inflationary pressures and retain a relatively soft exchange rate regime.
Let us now summarize what we have learned so far. We have seen the importance of the balance sheet in tracking money supply, but a more recent study of monetary policy links the movement in the central bank balance sheet to the determination of interest rates through bank reserves. One methodology is to compute the excess bank reserves as partly autonomous and discretionary, and then using the RBI balance sheet on the basis of these policy interventions. Secondly, we can decompose the excess reserves into exogenous and forecast-able factors on the degree of predictability and policy positions. As far as the accounting practices of RBI are concerned, it by and large satisfies the policies which have been framed by the International Monetary Fund. There has been a growing importance of the strength of the central bank balance sheet with financial liberalization.